Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Today, we're taking a look at the prospects for the venture capital trust sector in 2016. Venture capital trusts, commonly known as VCTs, provide finance to some of the most dynamic small companies in the UK to help them grow. Though the companies that VCTs invest in start small and are high risk, they can grow into household names, helping to create jobs and generate economic growth. So the government offers generous tax breaks to compensate for the risks involved. Now, 2015 was a good year for VCTs in performance terms, with the average VCT up 9%, and the fundraising was the fourth highest ever. So let's see what our managers think about the opportunities for VCTs and the impact of the new VCT rule changes. We've got here Dr Paul Jourdan. He's CEO of the Amati Global Investors, who manage Amati VCTs, and they're in the VCT AIM-quoted sector.
Hello, Annabel.
Hello. Now we've also got Tom Thorp here, who's a director of Foresight Group, who manage the Foresight VCTs.
Good afternoon.
And finally, we've got Stuart Veale. He's a managing partner of Beringea, who manage the ProVen VCTs.
Hello, Annabel.
On to the first question. So, Stuart, where are you finding opportunities for your portfolio?
Well, the main things we look for in our portfolio companies are the ability to grow quickly and to grow to a significant scale. And those companies can be in a range of different sectors. Having said that, some of the sectors that we find particularly fruitful at the moment for new investment opportunities include digital media, branded consumer goods, software as a service, and a range of disruptive internet-based business models. Last year we had 3 companies in the Fast Track 100 list of fastest growing companies in the UK, one of which was in the internet advertising space. Another one is a manufacturer of charging points for electric vehicles, and the third one is a retailer of branded watches.
Very diverse.
Yeah.
So Tom, how about you?
For us, I mean, it's very similar to Stuart. I mean, we focus a lot on business services as well as software as a service type businesses. I mean, we're very generalist in what we invest in. Foresight, everything from industrials, manufacturing type businesses, all the way through to the digital economy. And I'm very pleased to say there are lots of great opportunities out there that the VCTs are able to support. So we're really pleased by the pipeline that we see at the moment.
Great. And Paul, how about you? Yours is a little bit different because it's on the AIM-quoted sector, isn't it?
Yes, we're looking for companies that are floating on AIM or raising money on the AIM market, and we're likewise also looking for growth companies that are capable of growing substantially over the years following our investment. And one theme that we've noticed over the last couple of years is that there's a strong current in the AIM market of companies which are being bought for because they qualify for inheritance tax relief after 2 years. And this has created a premium end of the market. So we're really looking for companies which are not known about at the time we invest in them very widely, but within a couple of years of us investing them, we'll get into this sweet spot of the AIM market.
Yeah, well, I can see that's an opportunity. So Tom, how do you decide which companies you're going to invest in?
I think to us, the key thing about companies that you want to invest in is relationships, building up a really good relationship with the management team. So we spend a lot of time working with that management team, getting them in front of members of our investment committee to ultimately make sure that there is the buy-in early on in the due diligence process from our key decision makers and equally from the rest of the team. Because once you've built up that relationship with the management team through the sort of the 4 to 6 years that we work alongside them through to an exit, it's absolutely critical to make sure we're aligned with all the stakeholders in the business. So that's sort of one of the key areas that we focus in on.
Right, and Paul?
Because we're investing on AIM, we're generally using public information to weigh up companies. But when a company does come to market, to the AIM market, we are given a fantastic document known as the admission document, which is effectively a complete due diligence pack on that business with legal due diligence and financial due diligence and so on, and very detailed analysis of the business plan. So we're going back to documents such as that for weighing up businesses.
Okay, and what does a VCT manager bring to a company apart from money, Stuart?
Well, we want to support our businesses with management support as well as just the finance. So we always put one of our investment team on the board of the companies that we invest in as a non-executive director, and they can help the business in a number of ways. One of the key ways is in helping to build out the management team. Often when we invest, these relatively small companies only have a core management team, and we can work with that core founding team to identify gaps in the board and help the company to recruit people with the appropriate skills to help that business grow. In particular, we always look to appoint a non-executive chairman who's got relevant industry or functional expertise, who can act as a sounding board for the managers that we're backing.
Right. And how about you, Tom? Do you act similarly as that?
Yes, no, we're very similar. I mean, to me, it's absolutely critical to put a non-exec chairman onto the board to help with the strategy and ultimately to bring the best out of the management team. I think the other thing that we like to do is bring best practice to new teams that we've invested in. So often within our portfolio, we've got about 35 companies in the portfolio. We do have similar businesses. So we get the businesses to work alongside each other to share best practice when it comes to some of the dynamics within those industries that are particularly unique. So it's making sure we leverage the relationships that we have within our existing portfolio companies to ultimately maximise what they're trying to achieve. And I think the other thing that we work very closely on as sort of investor directors on the board is keeping the exit strategy front and centre as well. So we make sure we're aware of what's happening in the market, what opportunities are out there, and the relevant sort of corporate finance advisors who could be interested in an exit mandate at the appropriate time.
Yeah, very important. So Paul, on the AIM market, what expertise do you bring apart from just money?
Well, clearly, one of the features of public markets is that we're not a dominant shareholder with the companies in the way that you would be with private equity. So we're typically owning maybe between 3 and 10% of a business. We are selectively active with companies, so we're not. If we feel that everything is just fine with the business, then we'll sit back and meet them twice a year, and that's perfect. Those are in some ways are our dream investments. So they're long term, and they're not going to absorb huge amounts of stress from us. Other investments will be much more involved in advising the business, maybe on strategy or on their board. We will get involved in discussions about some quite detailed matters of corporate governance. Sometimes we're consulted if we're a big shareholder. It's very varied, but we're happy to be as involved as we need to be.
Now, we've got some new VCT rules which were introduced in the autumn. Can you summarise them for me, Stuart?
Well, the main objective of these new rules, which are really driven by the European Union, is to make sure that VCT investment is directed towards earlier stage, high growth companies, and the money is used for organic growth rather than for acquisition. So the three main areas that the rules affect are that the investment can't be used to acquire businesses. The VCT investment can't be used to acquire businesses. The investment must go into companies which have only been trading for less than 7 years, with a number of exceptions which will allow the VCTs to invest in older businesses. And thirdly, there's a limit on the amount that VCTs can invest, both in any 12-month period and over the life of the company.
Right. Now, what impact are these new rules going to have on your strategy, Tom?
Certainly for Foresight, I mean, we've always had a good balance between traditional management buyouts as well as growth capital deals. So for us, what it has meant is we're sort of reshaping our strategy to make sure that we're focusing solely on the growth capital side of things. And as I mentioned earlier, I mean, we see a really good pipeline of opportunities out there, earlier stage type businesses, which for us in our 32-year history have actually been very successful with some really good returns. So I think it's a really good opportunity for the VCT industry to back some great businesses with ambitious management teams who fundamentally should be able to deliver some very good returns to the shareholders.
Right, well that sounds encouraging. Paul, what impact is it going to have on your strategy?
I think in terms of strategy, there'll be some companies that we could have invested in the past that we won't be able to invest in the future, but we're not expecting to have to make a major change to strategy. The rules will be digested and the market will adapt and we'll adapt. I think that in the short term there is an impact just from the complexity of the new rules. and that the details of the new rules are not quite clear in every respect yet. So we've anticipated quite a quiet period following the rule changes while the market adapts, while the guidance is published and understood. And I think for all managers actually in over the next 6 months, every deal we do is going to be a lot more work, because we're going to have to check lots and lots of different aspects of every company we invest in against all of the new rules.
Right, and you, Stuart, what impact will it have?
I don't think it's going to have a very large impact on us, because our investment strategy has always been to provide growth capital to businesses, fairly early stage businesses which have got the potential to grow rapidly. So when we look back at the deals that we've done over the last 18 months or so, virtually all of them would have qualified under the new rules. So I'm hoping there won't be much of an impact on us.
Minimal impact by the sound of it.
Yeah.
So, is it a good time to invest in VCTs, Paul?
I think it's a time where there's clearly some nervousness in the market, and assets generally around the world are at quite high levels because of quantitative easing and lots of liquidity flowing into the market. But it's always easy to put off investment decisions, and for most people, buying a VCT is a kind of annual decision. And for annual investment in VCs, I think it's a very good time. It's always easy to feel scared, and there are palpable risks around, and they're not going to go away. But there are very few places I'd rather have my money invested than in good growth companies in the UK. I think we've got a really excellent environment here for entrepreneurs to develop great businesses.
Excellent, excellent. Tom?
Yes, I mean, I'd like to further that point that Paul's made. I mean, we see some really, really outstanding UK SMEs that are crying out for investment. And so I think from a VCT shareholder perspective, now is the time to continue to put money into VCTs, because the opportunities are there, and they're really encouraged by the opportunities that I think managers like us who have a long track record of investing in this space, they can see the value that we bring. We touched on, other than money, what else do we bring? That sort of corporate governance side, the assistance with shaping a strategy is a really key thing. So I think when the VCT monies keep coming into each of the VCTs, we're working hard to make sure we can deploy that into a diverse range of businesses to make sure the portfolio is nicely spread.
And Stuart, is now a good time to invest in VCTs? And I'm thinking about the pension changes and other implications.
Yes, I mean, I think it's important to say that a VCT investment is not appropriate for everybody, and if people aren't sure whether it's right for them, they should take professional advice before investing. But for those people for whom it is an appropriate investment, it's important to remember that not only are the VCTs delivering good investment returns, but there are also significant tax advantages to investing in a VCT. So 30% income tax relief on the initial investment, and also tax-free income, which can be very attractive. And that's particularly relevant to people who are now restricted from putting more money into pensions, either because of the reduction in the annual allowance for pensions or the lifetime allowance. And if you're in that situation, then VCTs are a very good alternative with similar characteristics.
I'd like to thank all of our managers for your very interesting views. VCTs invest in small companies and are therefore high risk. VCTs are intended as long-term investments, and you have to hold on to the shares for 5 years to gain some of the tax benefits. If you are in any doubt whether VCTs are suitable for you, you should take independent financial advice. Thanks so much for watching today.